Welcome to the Explainer. Today we are diving deep into something called candle range theory, or CRT for short. Now this is a really powerful idea that suggests the secret to finding key trading levels isn't buried in a bunch of complex indicators, but it's actually hiding in plain sight, inside every single candlestick on your chart. Let's break down exactly how you can start to see it.
So, here's the game plan. We're going to start with the core concept, what this is all about. Then we'll build a simple 3-candle setup that you can spot. After that, we're going to level it up to a professional-grade strategy, apply the whole thing to a real chart so you can see it in action, and then wrap up with the must-know rules to keep you on the right track.
All right, let's get right into it. What is candle range theory at its very core? Let's build this thing from the ground up.
The whole theory, the entire thing, really boils down to this one simple question. Just think about it for a second. What if the most important levels, the ones everyone is trying to find with trend lines and indicators, what if they were right there, hiding inside each and every candle?
Well, that's exactly what CRT proposes. It says that every single candle creates its own little trading range. The top of the candle becomes the candle range high, and the bottom becomes the candle range low. And these two specific levels, they act like magnets, often pulling price back to them in the near future. And here's why this is such a game changer. It radically simplifies your chart analysis. Instead of clicking through tons of different timeframes trying to find support and resistance, CRT lets you identify two super critical points of liquidity just by looking at a single candle. It's incredibly efficient.
Okay, so that's the theory. But how do we actually trade this? Well, let's see how this idea turns into a simple, actionable strategy. It all comes down to a basic 3-candle setup.
The whole setup really just boils down to this repeatable 3-step dance. First, you have one candle that establishes the range, the high and the low. Second, the very next candle sweeps liquidity. It pokes outside that range, but then it fails by closing back inside. And that failure? That's our cue. That's our potential entry signal.
Now, listen up, because this is probably the most critical part of the whole thing. You have to know the difference between a sweep and a breakout. A valid sweep, the kind we want to trade, is basically a failed breakout. See how the wick just stabs below the range, but the candle's body snaps back and closes inside? That move traps traders who went short. Now, if the body closes outside, forget it. That's a real breakout, and our setup is totally invalid.
So that was the basic idea. But here's the thing. Trading it just like that can get you into a lot of trouble. So now, let's take this concept and make it much, much more powerful by aligning it with the overall market direction.
The biggest weakness of that simple model is that it doesn't care about the trend. And because of that, it can often have you trying to catch a falling knife or short a runaway train, which is, a really low probability game. We need a much smarter filter.
And the solution is actually pretty elegant. Instead of fighting the river, we just decide to trade with the current. So we're not taking every signal we see. Instead, we wait for a clear trend, and then we wait for a small pullback against that trend. That brief little pause, that's our golden opportunity to find a high probability entry that gets us back in sync with the market's flow.
Okay, so here's the step-by-step setup for a high probability long trade. First, the market has to be in a clear uptrend. Then, during that uptrend, we actually start ignoring all the green bullish candles. It sounds weird, but our focus is only on the red bearish pullback candles. We're patiently waiting for one of those red candles to show a failed attempt to push lower. When we see that sweep, that's our signal to get ready to buy.
Now, if you want to get really precise with your entry, I'm talking sniper level precision. We add one final step. So after we see that valid sweep on our main chart, let's say the 1 hour, we then zoom into a lower time frame, like the 5-minute. And we're not just buying blindly. We are looking for a very specific pattern called a fair value gap to confirm the move and pinpoint our exact entry price.
So you're probably asking, what on earth is a fair value gap? Don't worry, it sounds way more complicated than it is. Just think of it like a small pocket of inefficiency in the market. It's a 3-candle pattern that shows up when price moves so fast that it kind of leaves a void behind. And the market just loves to come back and revisit these little gaps, which makes them powerful magnets for price.
Okay, getting in the trade is one thing, but this management technique is absolutely critical. It's how you protect your capital. So once the price moves in your favor and hits a 1-to-1 risk-to-reward target, you close half of your position. Pay yourself. Now the trade is totally risk-free, and you can let the other half run without any stress, even if it ends up reversing later. All right, theory is great, but let's see how all these rules come together and play out on a real chart in the real world.
Okay, so we're looking at the euro versus the US dollar on the 1-hour chart. And as you can pretty clearly see, the market is in an uptrend. So what does our rulebook say? Simple. We are only interested in buying opportunities. We ignore everything else. Let's walk through the entire sequence right here on this chart. It all starts on the 1-hour time frame. First, we spot that red bearish pullback candle, and we mark its low. Then, boom, the next candle gives us that perfect, valid sweep, closing back inside the range. That's our cue to immediately dive into the 5-minute chart, where we find our fair value gap for a super precise entry. And finally, once we're in the trade, we manage it like a pro by taking those partial profits to make it risk-free.
Okay, that was a lot to take in, I know. So, to wrap things up and make sure this all sticks, let's boil this entire strategy down into a simple checklist of what to do and, just as importantly, what not to do.
Avoiding these 3 mistakes is absolutely crucial if you want to make this strategy work. First, don't even try this in a choppy, sideways market. It needs a clear trend to function. Second, you have to be patient. Always wait for the candle to close before you act. And finally, never trade in a vacuum. You have to be aware of the bigger market picture. News, major support and resistance, all of it.
And if you remember just one thing from this entire explainer, please make it this. Context is everything. A setup that looks absolutely perfect is still a bad setup if it's happening in the wrong market environment.
So from now on, before you even think about placing a trade with this strategy, just run through this super simple checklist. Is there a clear trend? Yes or no? Is there a pullback? Yes or no? Did a valid sweep just happen? And is there a fair value gap for my entry? If you can't check all 4 of those boxes with a confident yes, just stay out of the market. Simple as that.
And that's our deep dive into a simplified, trend-following approach to candle range theory. So the final question I have for you is this. Now that you know how to see this hidden story of liquidity playing out in each and every candle, how might this new lens totally transform your entire approach to reading the market?